Hello, everyone. Welcome back to the Final Bar. This is your host, Dave Keller, here at StockCharts.com in Redmond, Washington. Thanks so much for joining us today and every day to unwrap today's price action. I want to bring on a familiar face, familiar voice to many of you, a longtime StockCharts contributor and a friend, Tom Bowley. Tom, thanks for joining today. I appreciate it.
Hey, thanks for having me, Dave. It's awesome to be here.
Always enjoyed coming on Market Watchers Live with you. Excited to watch your new show, Trading Places with Tom Bowley, and seeing how you're doing it. And you took some time to send us 5 charts ahead of time, which I'm really interested to see how you lay this out. Can we get going with the first one? This is sort of a long-term secular bull bear cycle look.
Yeah, I'm a real short-term trader, so I thought I'd bring up a 100-year monthly chart.
Perfect.
On the S&P 500. Actually, I just wanted to go through and explain the market goes through these generational type cycles. And that's all I was pointing out here on this chart is that, you go back into the 1930s and 40s, we had a secular bear market. Then for 2 decades in the 50s and 60s, a secular bull market. Then again, we went through the 70s into early 80s, another secular bear. Huge 2-decade run in the 80s and 90s, secular bull. And then from 2000 through about 2012, again, a secular bear, sideways consolidating. I believe in 2013, when we broke out, we entered a secular bull market. I think that it doesn't mean you're not going to come down. It doesn't even mean we're not going to have recessions. If you look back in history, the 1950s, 1960s, the 1980s, 1990s, during those secular bull markets, we had multiple recessions. The problem is, well, for the shorts, the problem is that these recessions generally don't take big hits like 2000 to 2002 and 2007 to 2009. So I thought what I would do is just show the audience an example of what happens when you have a recession and when you have a cyclical bear market within a bull market. So here's the S&P 500 back in 1990. On that long-term monthly chart, it was a little blip on the radar, but here you can see that in 3 months, the S&P 500 fell from 370 down to about 295, or a little bit more than 20%. And if you think back to what happened at the end of 2018 in the fourth quarter, you can show that next chart, Dave.
Yep.
It's almost the exact same thing. Everybody was worried because, we're coming out of the huge secular bear market, and we start talking about recession, trade war, Fed, this, that, and you start thinking because of recency bias that everything is going to just get hit. We're going to be in this long 2-year drawn out move to the downside. And I just want to point out that's not what happens. Here, 20% correction, a cyclical bear market in 3 months, and then we go higher. So I think we're going to go higher. I think there's 2 catalysts to really pay attention to. The first being transports. I know you mentioned it a little bit ago. Yeah. I am watching the transports like a hawk. Those periods of consolidation on the S&P that were circled, you can take a look below. Transports and small caps struggled during those periods. But when those 2 areas, transports and small caps, break out, that's when the S&P 500 generally goes on a big move to the upside. So that's what we're going to kind of want to keep an eye on. And then also the rotation. So you've got to be looking at the Treasury market and the S&P 500. And there you have it. When you see that Treasury yield moving higher, like it was in 2017 throughout 2018, that tends to coincide with a big push higher in the S&P 500. So those are some of the things that I'm looking at. I don't know how you feel about the market going forward, this quarter and then 2020, but I'm pretty bullish.
It's certainly, you certainly seem to be, and you make a compelling case to do so. And what I love about this, the historical perspective, too often 1990 feels like ancient history, but there's some really good lessons in terms of a cyclical bear market, how that fits into the big picture. I'm curious, given that you're fairly constructive, again, with good technical reason for that, what would you see that would tell you that you're wrong? What would you see that might cause you to revisit a more bullish positioning or thesis? Is there a particular chart you'd be looking at, or is there a particular level we would break down, or a particular signal? Like what would you be looking for?
Well, to the upside, I'd be nervous if the market breaks out and all of a sudden we see leadership from defensive groups. So, right now it's okay to be led by defense when you're consolidating or you're pulling back. In fact, that's normal. But if you look back into history, 2007, when the market topped, we actually started seeing money rotating away from some of the aggressive groups and into the defensive to lead the last leg of that bull market. That would make me really nervous to the upside. To the downside, I just think the S&P 500 has been in a beautiful channel for 10 years. And I think if the S&P went down back below about 2,600, I'd have to reevaluate. And that may seem like, wow, you're kind of you're kind of calling for both things. I'm not really calling for the market to go back down, but
Right.
we have to recognize, what we have out there. We got the trade war. I mean, if all of a sudden we start getting some negative tweets again, we know what can happen. I don't think that a couple hundred points to the downside would squash that 100-year chart that you had pulled up earlier, but
Right.
that's something we have to be aware of.
It's interesting. I remember in particular at the 2007 high, noticing things like Pepsi looking really, really good. And somewhere in the back of my mind thinking, this does not feel great that is one of the best charts out there, because it just kept pushing higher. And again, that was sort of the end, right? When that was sort of the leadership on there.
Yeah, I know consumer discretionary, a lot of the consumer stocks, especially the discretionary, the more aggressive groups, really took a hit in that last push to the upside. I think they may have topped out on a relative basis back in like 2005, 2006,
Right.
when construction topped. And so that could be a warning sign.
Tom, as always, when I see someone like you share some charts, I'm humbled at how much you know about stock charts and how unequipped I am to use the product as well as you do. So thanks for showing some charts that actually really highlight, the long-term perspective on it. Really, really well done. I appreciate it.
Hey, I check in to your show quite often, Dave. I think you're doing a great job, but love the final bar. And we'll see. We'll see what happens. I'm bullish, but hey, I'm wrong quite a bit too. We'll just have to wait and see how this plays out.